How is investing different from gambling? Today, we're diving into a fascinating secret that could completely transform your financial outlook. Are you ready? Because what I'm about to share might just surprise you and change the way you think about money forever. Imagine yourself walking down a bustling street. On your left, you see a vendor hosting a game that looks simple and fun. The vendor confidently declares that this game has been running for hundreds of years, is open 24/7, and welcomes anyone to try their luck. Tempting, right? But hold on, don't place your bets just yet. Because on your right, there's another vendor offering what looks like the exact same game. But here's the twist. The subtle difference between these two games could be the line between becoming a millionaire or going broke. The left booth, where gambling lives. Let's start with the left booth. Here the vendor uses a standard deck of cards. Each time you place a $1 bet, you stand to win $53 if you guess the correct card. Sounds fair, right? But here's the brutal truth. Unless you're the 1 in a million lucky player, the odds will eventually strip you of all your money. This is the very essence of gambling, a system designed for you to lose in the long run. The right booth, the art of investing. Now let's shift our attention to the right booth. They also use a deck of cards, and each bet costs $1. If you win, you'll earn $50, $3 less than the left booth. At first glance, this might seem less appealing, but here's the catch. This booth has removed the 2 jokers and 3 other cards from the deck, making your odds of winning slightly better. You might wonder, isn't that unfair? Actually, this difference is what separates investing from gambling. If you play long enough in the right booth, unless you're exceptionally unlucky, you'll gradually take the vendor's money instead. The power of probability. So, why does the right booth, despite its lower payout, give you an advantage? The answer lies in a single, magical word: probability. With just a small edge of 2%, wealth becomes a matter of time rather than luck. This principle is why Warren Buffett famously said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." Investing isn't about taking wild risks. It's about finding opportunities where the odds are stacked slightly in your favor, like playing with a loaded coin that has a 51% chance of landing heads instead of tails. The difference may seem tiny, but over time, it's the edge that creates wealth. The harsh reality. But here's the harsh truth. Real investors are like treasure hunters searching for that elusive right booth in a vast ocean of gambling tables. The owners of these right booths are often like phantoms, hard to spot and even harder to trust. Success in investing demands not just persistence, but also a keen eye to separate the real opportunities from the traps. A simple coin toss example. Let's simplify this with a coin toss. Imagine you're playing a game. Heads, you win $1, tails, you lose $1. Seems fair, right? But now imagine someone tells you the coin is slightly biased. There's a 51% chance it'll land on heads. Wouldn't you bet on heads every time? This is the essence of investing. Finding games where the odds are tilted in your favor. In contrast, gambling is often a zero-sum or even negative-sum game. Casinos always take their cut, ensuring that most players lose in the long run. Investing, on the other hand, is about identifying those loaded coins, where the odds are just slightly in your favor. The casino's greatest fear. Let's return to the left booth for a moment. Do you know what casinos fear the most? It's not players who stay and play all day. Casinos know these players will eventually lose. What they fear are the ones who know when to walk away with their winnings. But let's be honest. How many of us can resist the temptation to keep playing? Most people are blinded by greed, chasing the high of one more win, only to walk away empty-handed. The key takeaway. So, what's the big takeaway? Gambling and investing may look similar on the surface, but they're worlds apart in practice. Gambling relies on luck, often with odds rigged against you. Investing, on the other hand, is about finding that 51% edge and staying disciplined enough to play the long game. Remember, wealth isn't built on chasing wild risks or instant gratification. It's built on strategy, patience, and stacking the odds in your favor. So, the next time you're faced with a financial decision, ask yourself, are you playing at the left booth or the right one? Investing versus gambling, a tale of two paths. Hello everyone, let's explore a fascinating real-world example. Back in 2017, a woman named Sia J. Brannon, a server at a Las Vegas casino, hit a jaw-dropping jackpot worth $34.9 million. But here's the tragic twist. Just 9 weeks later, she was involved in a devastating car accident that left her paralyzed. Her story reminds us that even when fortune smiles on you, life can take unexpected, heartbreaking turns. Now, let's contrast this with the story of Warren Buffett. In 1965, he took control of Berkshire Hathaway, and by 2021, the company's stock price had grown over 226,000%. This wasn't luck. It was the result of relentless learning, deep analysis, and making calculated decisions. So, what's the true meaning of investing? Legendary investor Charlie Munger once said, "Most people who achieve great outcomes have three things in common. They're very smart, they work exceptionally hard, and they're very lucky." But let's face it, most of us aren't geniuses. What can we do then? Munger's answer is simple. Start early, work persistently, and over time you may develop one or two of those traits. This is the essence of investing: continuous learning, accumulating experience, and sharpening your ability to see opportunities clearly. Buffett's investment formula. Take a look at Warren Buffett's habits. Did you know he spends 5 to 6 hours a day reading? Annual reports, financial statements, industry news, you name it. That's how he sifts through the vast ocean of the market to find businesses of real value. But here's the good news. You don't need to become Warren Buffett to invest successfully. You just need to outwork most people and, most importantly, be more patient. Investing isn't a sprint. It's a marathon. The market's emotional roller coaster. Now let's talk about the stock market today. Recently, aluminum stocks have plummeted, causing many investors to panic and sell off their shares without fully understanding their losses. Social media is flooded with negative market sentiment, fueling a wave of fear. Some analysts are even warning against investing in stocks at all, while others predict major indices like those in China could dip below 1,600 points, with no bull market in sight for the next 5 years. Sounds terrifying, doesn't it? But here's an incredible truth. Moments of market chaos like this often present the best investment opportunities. Lessons from history. Let's take a step back to 2008 during the global financial crisis. The Dow Jones Industrial Average fell from 14,164 in October 2007 to just 6,547 in March 2009, a staggering 50% drop. Many thought it was the end of the world and sold their shares in panic. But those who stayed calm, or better yet, bought more during the crash, reaped extraordinary rewards in the decade that followed. This is why Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." But staying calm during a market meltdown isn't easy. It requires immense courage and discipline. And yet, these emotional swings in the market, like those in 1994, 1999, or 2005, have often signaled the end of bear markets and the beginning of bull runs. Avoiding the herd mentality. Let's revisit 1999, at the height of the dot-com bubble. Investors were pouring money into internet companies with no profits, convinced that this time is different. Buffett, however, stayed true to his value investing philosophy and refused to join the frenzy. When the bubble burst in 2000, many who chased the hype suffered heavy losses, while Buffett remained unscathed. This highlights the importance of understanding history. As Mark Twain said, history doesn't repeat itself, but it often rhymes. How to invest in a chaotic market. So, in times of market madness like today, how should you invest? The answer lies in value investing. And what's the core of value investing? It's treating a stock as a piece of ownership in a real business. Imagine you could buy shares of high-quality companies like Apple, Microsoft, or Amazon at a bargain price. Would you panic? Of course not. Because you know the intrinsic value of these companies far exceeds their current market price. The bottom line. Whether it's a jackpot win or a stock market investment, one thing remains clear. Luck is fleeting, but discipline, knowledge, and strategy endure. Don't be swayed by the emotional highs and lows of the market or life's unexpected twists. Instead, focus on what you can control: your effort, patience, and ability to spot opportunities. Because in the end, investing isn't just about making money. It's about playing the long game, staying calm when others panic, and letting the power of time and probability work in your favor. The power of value investing. A lesson from real life. Let's dive into a real-world example. In March 2020, when the COVID-19 pandemic hit, panic gripped the markets, causing many high-quality stocks to plummet. Apple's stock price, for instance, dropped from around $80 in mid-February to about $55 by the end of March, a staggering decline of over 30%. But savvy investors who understood Apple's true value didn't panic. Instead, they saw this as a rare opportunity to buy. And the results? By the end of 2021, Apple's stock price had soared to around $180, a gain of over 200%. This demonstrates the power of value investing. When you truly understand a company's worth, short-term market fluctuations become your ally, not your enemy. The harsh truth about individual investors. Unfortunately, here's the reality. Most individual investors lack the ability to identify great businesses. As Charlie Munger famously said, "For many individuals, investing is akin to gambling. They don't know anything about the business or what's happening. They're just chasing prices." This is why most retail investors ultimately lose money. They're not investing. They're speculating. A tale of two outcomes. GameStop in 2021. Consider the GameStop frenzy in January 2021. The stock skyrocketed thanks to a movement fueled by retail investors on Reddit, soaring from around $20 to $483 in just a few weeks. Many individuals bought in at the peak, dreaming of even greater gains. But when the bubble burst, the price quickly plummeted to about $40, leaving those who bought at the top with massive losses. This cautionary tale highlights the dangers of blindly chasing trends and short-term speculation. True investing is rooted in a deep understanding of a company's fundamentals, not in trying to predict stock price movements. The risk of quantitative investing. You might now ask, what about quantitative investing? Shouldn't we rely on algorithms to make decisions? Here's a surprising truth. Many quantitative investment strategies are just high-stakes gambling in disguise. Charlie Munger has pointed out that quantitative funds often rely on repeating the same algorithmic trades year after year, maximizing returns by increasing leverage. While this can lead to short-term gains, the excessive use of leverage introduces significant risks. Over time, the higher trading volume often results in diminishing returns, leaving these funds vulnerable to catastrophic failures. The rise and fall of LTCM take long-term capital management, LTCM, for example. This hedge fund, founded by Nobel Prize-winning economists, seemed unstoppable until it wasn't. In 1998, the fund collapsed due to excessive leverage. LTCM's sophisticated mathematical models worked well in normal market conditions, generating impressive returns. But when the Russian financial crisis hit in 1998, their models failed catastrophically. In just a few months, LTCM lost $4.6 billion and had to be bailed out by Wall Street banks under the coordination of the Federal Reserve. This story serves as a stark reminder that even the smartest individuals, armed with the most advanced tools, can fail if they overestimate their abilities and underestimate risks. The fundamental difference between investing and gambling. Quantitative investing is not a silver bullet. It requires caution and wisdom, just like any other strategy. Now let's revisit our original question. What's the difference between investing and gambling? On the surface, they might seem similar. Both aim to generate profits in a short period of time, and neither directly creates new societal value. But here's the key difference. Investing is based on research and a deep understanding of companies, industries, and the economy. Gambling, on the other hand, relies purely on luck. When investors buy stocks, they're effectively purchasing ownership in a company. They care about factors like the company's fundamentals, the management team's capabilities, and the industry's growth prospects. Gamblers, in contrast, don't care about any of this. They're only interested in the next card, roll of the dice, or number on the roulette wheel. An illustrative example. Imagine you have $10,000. You could choose to gamble it at a roulette table, or invest it in a company you've thoroughly researched. If you go to the casino, your odds are fixed and always favor the house. Over time, you're almost guaranteed to lose your entire stake. But if you choose to invest, the outcome can be drastically different. Let's say you've done your homework on Amazon, understanding its business model, competitive advantages, and growth potential. In 2010, you decide to invest your $10,000 in Amazon stock. By 2022, that investment could have grown to over $300,000. This is the fundamental difference. Investing is a decision grounded in knowledge and analysis, while gambling is a blind leap of faith. The key takeaway. The stock market isn't a casino, but it can feel like one for those who don't understand what they're doing. The good news is, with education, patience, and a focus on value, anyone can move from speculation to true investing. The next time you're tempted to follow a trend or make a quick trade, ask yourself, am I gambling or am I investing? Because at the end of the day, the difference between the two could mean the difference between losing everything or building a fortune. How to become a successful investor. So, how can you become a successful investor? Let's break it down step by step, because investing isn't a guessing game. It's a skill that anyone can master with the right mindset, knowledge, and discipline. 1. Lifelong learning. Continuous learning is your foundation. Successful investors are perpetual students. Dive into annual reports, financial statements, industry analysis, and investment books. Attend workshops, online courses, and listen to the wisdom of seasoned investors like Warren Buffett or Charlie Munger. Education is your greatest asset in the investing world. 2. In-depth research. Good investment decisions come from deep understanding. Study companies and industries thoroughly before investing. Understand a company's business model, its competitive edge, financial health, and leadership team. Evaluate industry trends, competition, and regulatory environments. Think of yourself as an investigator, uncovering hidden value. 3. Patience is key. Investing is not a get-rich-quick scheme. It's a long game. As Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. Stop chasing overnight wealth and focus on long-term growth. Wealth built over decades lasts longer than wealth built overnight. 4th, discipline and strategy. Create a sound investment strategy and stick to it. Don't let short-term market swings dictate your decisions. When the market panics, stay calm. When it's overly optimistic, keep your cool. Discipline separates successful investors from emotional speculators. 5. Independent thinking. Don't blindly follow advice or chase the herd. The best investors make decisions based on their own research and judgment. Develop a mindset that questions everything. Remember, in the end, you are responsible for your financial decisions. 6. Diversify your investments. Never put all your eggs in one basket. Spread your investments across sectors, industries, and even geographic regions to mitigate risk. Diversification protects you from unexpected downturns in any one area. 7. Control costs. High costs can erode your returns over time. Be mindful of transaction fees, taxes, and other investment expenses. For many, low-cost index funds are a simple yet effective way to grow wealth steadily. 8. Regular monitoring. Check your portfolio periodically, but avoid reacting to every market fluctuation. Markets can be noisy. Focus on the fundamentals of the companies you invest in. Adjust your strategy only when necessary, and don't overtrade out of fear or greed. 9. Stay humble. No one, not even the greatest investors, can predict the market perfectly. Mistakes are inevitable. Keep an open mind and a willingness to learn from errors. As the market evolves, so should your strategies. 10. Manage your emotions. Investing is as much about controlling your emotions as it is about crunching numbers. Greed, fear, and impatience are the enemies of good decision-making. Train yourself to stay calm during market booms and busts. Remember, volatility is normal. It's your reaction to it that matters. An example in practice: investing in Apple. Let's say you're interested in the tech sector and decide to evaluate Apple. Here's what you'd do. 1. Research financials. Dive into Apple's financial statements. Study revenue streams, profit margins, cash flow, and debt levels. 2. Analyze products. Look at Apple's product lineup: iPhones, iPads, and Macs. Assess market share and growth potential for each. 3. Evaluate services. Don't overlook Apple's services like the App Store and Apple Music. These recurring revenue streams are critical to Apple's future. 4. Examine industry trends. Analyze how trends like 5G, AI, and big data are shaping the tech industry. 5. Assess competition. Compare Apple's strengths and weaknesses against rivals like Samsung and Huawei. 6. Consider macroeconomics. Look at global economic growth, trade policies, and currency fluctuations that might impact Apple. After completing this research, you can make a well-informed decision to invest. And even after investing, continue monitoring the company's performance and adapt your strategy as needed. The essence of investing. At its core, investing requires time, effort, and intellect. But the rewards are worth it. The distinction between investing and gambling lies in preparation. A gambler leaves their money to chance. An investor makes calculated, informed decisions. Imagine you have $10,000. You could gamble it at a roulette table where the odds are stacked against you. Or you could invest in a company you understand. For instance, in 2010, if you had invested $10,000 in Amazon after thoroughly researching its business, that investment could be worth over $300,000 by 2022. That's the power of informed investing. The critical choice. So, what will you choose? Will you gamble, leaving your financial future to luck? Or will you invest, building wealth through education, research, and patience? This decision will shape your financial destiny. Choose wisely, because your future is in your hands. The final thought. Build your investing legacy. Let's close with a quote from Charlie Munger. If you love what you do and the people you work with, you will never work a day in your life. This applies not only to business partnerships, but also to your relationship with the market. Find an investment strategy that aligns with your strengths and interests. Stick to it, and success will follow. Investing is a marathon, not a sprint. With patience, discipline, and a love for learning, you'll cross the finish line and smile as others drop out of the race. Today is the best day to take that first step. Stop gambling with your money and start building wealth the right way. Remember, every legendary investor started with a single decision. Make that decision today, and your future self will thank you. The financial world is waiting for you. Equip yourself with knowledge, sharpen your patience, and ground yourself in discipline. In this vast ocean of opportunities and challenges, write your own story. When you understand the difference between investing and gambling, and when you start thinking and acting like a true investor, your financial life will transform dramatically. You will no longer be a slave to the market. You will master it. So, my friend, are you ready? Are you ready to begin your investing journey? Remember, every great journey starts with a single step, and now is the best time to start. Take that step today and craft your legacy of wealth.